This is essentially just a conversation inside of my own mind that I'm sharing with you. None of this is financial advice. I'm not a financial advisor. If you have any questions about anything that I'm talking about in this video, please seek professional help, financial advisor or accountant or anybody that knows more than you and is certified. I, again, am not certified. This is just a conversation with myself in my own mind about what I should do in these changing times. So, opportunity cost. What is opportunity cost? And what's the price of it? Opportunity cost is that you cannot double spend a dollar. So where you put your $1, where you put your $10,000 or your $1,000,000 is a place that you cannot put more money into something else. If you have $1,000,000, you invest that $1,000,000 into Google, then you cannot invest $1,000,000 also into Nvidia. So the opportunity cost would be the money or the profit or the equity that you're losing by putting your money into something as opposed to something else. How this relates to investing in the sense that I use it would be that if I want to purchase, let's say, real estate, the cost of me to get into real estate would be, if I do an FHA, 3.5% down on the house. If I do a conventional loan, 20% down on a house. That's 20% of my capital that's locked up. If I'm living in the house, then the mortgage cost would also be an opportunity cost of things that I cannot use somewhere else. Right now we have a little over 6% interest rates on buying a house. So if you buy a house that's, let's say, $400,000, $500,000, your mortgage cost is going to be in the $4,000 range. If you rent the exact same house, your rental cost is going to be, in my area, it's going to be around $3,000 for a 3-bedroom house. For about the same house to purchase is going to be in the $4,000 range. So the difference in that would be about $1,000 a month. Plus your down payment, plus any other costs in maintaining, fixing the house. So you're losing in the difference to purchase or rent the exact same house, you're losing $1,000 plus your down payment cost. If you put this money somewhere else, so say you took the rental option and you took that extra $1,000 and you put it into purchasing equities, stocks, bonds, cryptos, commodities. Even if you put it into a CD and you gain 4% interest over the course of whatever the term is, 6 months, you will be gaining money. So the opportunity cost of you purchasing that house not only cost you the $1,000 difference, but it also cost you the opportunity to have something that would pay you more with that amount of money. That $1,000 would have paid you more from being into a CD than it would be going into your mortgage. The opportunity cost or the benefit to owning a house would probably be the equity that you get from the actual house, the appreciation in price. So as you own the house, as you're making payments on the house, the equity of the house, the value of the house is going up at X% for the entire time that you're there. If you choose to rent the house, the rental rates are probably going to go up by X% every single year while you're there. Once you're locked in the contract, it's not going to change until the contract or the lease gets renewed. Once that lease gets renewed, if they decide to up your rent by $200, then that brings you a little bit closer to that lost opportunity $1,000 that we were just talking about. So what can your money do in one place that it can't do in another place? Some places growth is where I'm concerned about my money is I want it to grow. If it's just sitting there, then it's not growing. I don't really want that. So what area is going to grow more than the next area? That's the real cost of opportunity. So if you buy something like a stock, a crypto, commodity, gold, silver, you can buy a CD or put your money in a high yield savings account. Those all should appreciate in value your capital, and differentiating between the gains on all of those is going to be your opportunity cost. Are you going to gain more by buying stock? Or are you going to gain more by buying crypto? Are you going to hopefully not lose less, but you should never really be aiming to lose, but are you going to gain more, or are you going to offset inflation by purchasing one thing over another? That's kind of what we're aiming for. Some people really just want to generate income, so they purchase real estate, they purchase a house, and they want to initiate a cash flow. They want to start making money off of a passive investment. The real estate isn't necessarily a passive investment, depending on how you set it up. You're always going to have different costs. You're going to have leaky faucets. You're going to have maintenance and repairs that you're going to have to be paying on this house. You're going to have to pay property taxes on this house. Property taxes will probably change over the course of your ownership of it. So that's going to be a variable cost that you can add in there, but you don't want to count on it being the exact same all the time. If you want to generate income from stocks, then you can buy, or stocks or ETFs, I guess I should say. You can buy dividend paying stocks, you can buy dividend paying ETFs. SPY is a pretty good one that's pretty stable price wise. So the next thing you have to think about is NAV erosion. NAV erosion would be the principal that you put in. If the cost of the stock or the ETF goes down or up, then that's your net asset value. Your net asset value is going to fluctuate depending on the pricing of it in the market. The dividend that gets generated can also fluctuate. Some companies have a high, they grow their dividend over years. So if they have a history of growing their dividend, then that's a sign to look out for. If they have non-stable asset value, if the price of the ETF or the stock is not stable, then that's something you also want to pay attention to. So you want your principal to stay pretty stable, pretty localized, and then you want your dividend growth to be either stable or growing. Stocks and ETFs, the dividends that you get paid out from these things, they aren't going to be huge amounts of money. They're not going to be large sums. So if you get a dividend of 2%, if you get a dividend of, they're typically going to be less than 10%. You can get SPY, which I mentioned earlier. It's a high dividend paying ETF that plays on the S&P. S&P is the 500 or 100 if you do S&P 100. It's the largest companies in America. So that's a pretty good route to go. It's going to be actively managed. So if somebody drops out of there, then they bring somebody else in. So you always have the top performers in the US market. Um, dividend growth on some things. You can do more risky plays for dividends. If you have cryptos, you can use crypto plays. There are companies that generate dividends based on the volatility in the market. So they'll sell covered calls and they'll sell covered puts, and they'll generate an income month to month. And that income is going to be what pays you out in dividends. So it's going to be a synthetic exposure to the actual underlying ticker, the underlying stock. A really popular one right now is called Misty. MSTY is the ticker symbol, and it generates a dividend based on the volatility of MicroStrategy, or Strategy as it's called now. Strategy bought a whole lot of Bitcoin, and people are purchasing MicroStrategy or Strategy stock to kind of simulate Bitcoin's returns with something that they can freely purchase in the stock market on the New York Stock Exchange. Some people cannot buy crypto directly, so they buy something that has direct exposure to it, and then that's an indirect play in the crypto markets. So as people buy and sell MicroStrategy, the price fluctuates a lot. So if you look at the MicroStrategy options pricing, it is very high and it swings very, very fast. So it has a high volatility. You're buying and selling these options, call options or put options, the prices swing really, really fast. MicroStrategy might be up 10, 15, 7% in a day, and then it also might be down the same amount in a day. Selling calls and selling puts is a more safe option than buying naked calls or buying naked puts, meaning that you don't have anything on the line. You're just saying the price is going to go up to this point by this date. And it's going to be the movement in between that you really make your money. You can sell a call option or a put option before the expiration date. And that's selling to close. If you sell to open, then you're putting a little bit more on the line. So if you sell a put, that means you have to have that amount of money, your strike price, that amount of money times 100, ready to go to buy that if need be. So you're loaning it out. You're loaning your money out for somebody else to buy a call or buy a put. If you sell a covered call, then you're saying that you have 100 shares of that stock for somebody else to loan or for somebody else to borrow from you and make money. Your plan is to make money and their plan is to make money. Not everybody's going to win. It's a tug of war. It's a negotiation. So when you start generating income off of the money that you have to, I guess, calculate what you could be doing with that money and what the best option is for you to maximize your return on that money. Dividend stocks are a great source. You should always have more than one source. You should always try to diversify as much as you can. Again, this is a conversation with me, myself, in my head, trying to coach myself as to what I need to be doing. What you can also do with a dividend stock or a dividend ETF is something called DRIP. That's Dividend Reinvestment Program. You'll take the dividends from the underlying and then you'll just reinvest that straight back into the stock or the ETF. And as time goes on, you're generating a bigger dividend because you keep recycling the dividend that's paid out back into the principal. So you're increasing your principal, your net asset value, even though you can have NAV erosion in the underlying stock, the price of it might keep going down. But if you start reinvesting and reinvesting as the price is going down, you're lowering your buy point, your dollar cost averaging in, and you're getting more shares per dollar spent as you are at the same time reinvesting what you already put in. So it's kind of compounding itself to be a bigger snowball. And as it keeps rolling, as time keeps passing, it keeps getting to be a bigger and bigger snowball. So the yield on the dividend is going to have a big major factor. It's going to be a big major factor in your choice of which ETF or stock that you want to use this on. So Misty is very, very interesting just because of the volatility of MicroStrategy. You're going to generate over 100% yearly on that stock. The dividend pays out monthly. So as you generate 10%, 10%, 10%, 10% every single month, it ends up being over 100% that you're getting back in the year. As long as your net asset value doesn't drop too low, it kind of makes sense that you're getting more cash flow in. So that's a cash flow play. You can also play some that are a little bit more stable, like the SPY. I think the yield on that is like 10%. That's a really good yield. Pepsi is a dividend payer. Home Depot is a dividend payer. The dividends that most of these pay are going to be very, very small. So they're more stable. They don't have the volatility. But also the dividend growth has been, if you look at it, if the dividend growth is growing and the cost of the stock is pretty stable or increasing, then you're doing pretty good. Even if you're getting a 2% return. If you rent out a house, you're only pulling in maybe 1 to 2% per month on the rental rate. If you purchase a house in cash, you're on that $500,000 house, you're only getting $3,000 back in rent. That's if you own the house outright and you don't have a mortgage on it. If you have a mortgage on it, then it could be much less than that. You might be generating $100, $200 a month on tying up that amount of funds on your down payment, along with whatever repairs or remodels that you've already done. Generating any type of cash flow is great. You just want to make sure it makes sense. So for you to tie up that much money into a real estate deal and not have that money available to purchase whatever else you want. If you're purchasing crypto, then that has a really high CAGR. So the annual growth rate is much higher on some things. A lot of cryptos, you're not going to generate a yield unless you're yield farming or you're staking or something like that. Commodities, you're not going to generate any type of income unless you're actually selling them. Selling them creates a taxable event. Stocks, you're not typically going to make any type of income unless you're buying dividend paying stocks. Real estate, you do have a chance to make a little bit of income, a little bit of cash flow. Just if you structure the deal right and you're able to put yourself in the position to where you can have some type of cash flow. Not all markets are going to allow for that. If you're buying at the top of the market at a high interest rate, you might be underwater if you decide to turn around and rent that out. So your future potential is what you want to base your decision on as far as the opportunity cost in deploying your funds in something beneficial. You can also look at very safe. Safe is it's a weird word. You can't really be safe when you're deploying your money. Safe is not even safe underneath your mattress. Safe isn't safe in a bank. But if you have to have money and you want to try to generate something off of it, you can also do things like CDs, certificate of deposit from a bank. You can lock up your money for a time period, 6 months, 5 months, 1 year. They'll give you 4% cash after the time period is finished. If you want to pull it out early, they're going to tax you on it. Or not tax you, but they're going to charge you fees for withdrawing early. If you leave it in there for the full 6 months, then they give you your 4% back. People think 4% isn't a whole lot of money. It just depends on the framework. It depends on your perspective. 4% of $100, yes, $4 is not a lot. But 4% on $10 million, it is quite a substantial amount of money. That could be living expenses for a year for some people. And that's a really more safe play than a lot of these other ones. So 4% is not terrible. This is all in your framing, how you think about things, what capital that you have to play with. So looking at the CAGR, looking at the annual growth rate from many different ventures that you can go down. Bitcoin and crypto is always very risky, but the rate of return that they have for cash on cash value is also very, very high. And that's why MicroStrategy has such volatility in its stock. Because the price of Bitcoin is now influencing the price of MicroStrategy stock, and people are selling options on it, buying options on it. Bitcoin moves 20%, MicroStrategy might move the same 20%, might move more, who knows? So, yeah, I think that's all I have for you. Just looking at your opportunity cost, where you're putting your money, and where you're not putting your money. You should also be probably diversified in your portfolio, just taking your portfolio and splitting it out into things that are high risk, low risk, medium risk, no risk. Having cash on the side, there is always a risk. You're going to get eaten up by inflation. Things out in the world are going to cost more than they did yesterday. That's what inflation is. It's not going to be them coming in your house and chopping the dollar in half. It's going to be that dollar not being able to buy a stick of gum anymore. It's going to be a carton of eggs costing $12, $15. It's going to be a gallon of milk doubling in price. And what you have to pay for it is still that $1 that you had sitting in your house. So you just have to watch the cost of inflation, and you have to kind of stay in front of it, keep up with it at least if you're not outpacing it. You should definitely aim to outpace it. If you can find something that's going to outpace inflation by a good amount, that's awesome. Do that. Again, not financial advice. I'm not a financial advisor. Do your own research. Definitely don't buy anything based on anything that some guy on YouTube says, whether that's me or anybody else. Have a good day. Hope you guys are all profitable in your ventures. Till next time, see you.